Qualcomm is one of the companies leading the huge tech boom we are currently experiencing, creating semiconductors, software and services related to wireless technology. And over the past 6 months, it is down by 23%. And so in today's video, I will figure out if this drop in price is justified or if right now it's a great opportunity to buy Qualcomm at a discount price. And as always, to do this, we will use our stock valuation spreadsheets where we will have a look at the fundamental 9-pillar analysis and calculate the intrinsic value of the company at the end of the video. Now before we start, if you find these spreadsheets helpful, you can always download them at the link in the description. Now first of all, let's have a look at Qualcomm's dividend. Currently they have a dividend yield of 2.12% with a dividend payout of $3.40 yearly and a trailing free cash flow payout ratio of 35.79%. And the reason why we have a look at the free cash flow payout ratio and not the general payout ratio is that dividends are always paid from a company's free cash flow. Qualcomm's payout ratio is nice and low, which means that they can still direct a lot of their free cash flow into innovation after paying out dividends, which is extremely important for companies in the technology sector. Something I also like about the company is the low difference between their market cap and their enterprise value, which is essentially debt. So we can see that the company only has about $2 billion in debt, which is almost nothing compared to their enterprise value. Now moving straight to the 9-pillar analysis, we can see that the company gets a rating of 9 out of 9, which is a very nice rating. Right away, let's have a look at the company's growth. We can see that their revenue has been growing at a rate of 12.83% yearly over the past 5 years on average. Their free cash flow has been increasing at a rate of 33.17% yearly, and net income has been growing at a rate of 28.29% yearly. Now you all know that I love when a company's free cash flow is higher and increasing at a higher rate than their net income, and that is the case with Qualcomm. If we have a look at the fourth pillar, the net income, we can see that in 2023 it was sitting at 10.1 billion. But if we have a look at the free cash flow in 2023, it was sitting at 11.1 billion, so 1 billion higher than the net income. Free cash flow is mainly used for 4 things. It's used for innovation, for buying back shares, paying off debt, and paying out a dividend. And so that again is why I love the free cash flow to be higher than the net income. So overall we can see that Qualcomm has great growth in all 3 pillars. But now let's have a look at some of the other pillars. So first of all, let's have a look at the decreasing shares outstanding. Qualcomm has been decreasing their shares outstanding at a rate of 0.33% yearly over the past 5 years, which means that they are increasing the value of the leftover shares outstanding, which I love. Their 5-year profit margin is also sitting above 10%, sitting at almost 60%, which is awesome. And their long-term liabilities over the 5-year free cash flow negative dividends is sitting at only 0.45, which means that they generate enough free cash flow to cover all their long-term liabilities in about 2.5 years, so they won't get into any trouble with debt. And they have also been decreasing their long-term liabilities at a rate of about 1.77% yearly over the past 5 years, which is something I love as well. Now, 2 extremely important metrics to always have a look at: the 5-year PE ratio and the 5-year price to free cash flow. If the PE ratio is higher than 22.5, investors are overpaying for the company's earnings, while when it is lower, they are underpaying, and therefore the company would be considered undervalued compared to their earnings. So if we have a closer look at the PE ratio, we can see that currently that is sitting at 17.96. So investors are underpaying for the company's earnings, paying only $17.96 for every dollar of Qualcomm's earnings. And that is the same case with the price to free cash flow. They are currently paying $16.27 for every dollar of Qualcomm's free cash flow. So what we can see from this is that Qualcomm is undervalued compared to their earnings and compared to their free cash flow. And finally, let's have a look at Qualcomm's consecutive dividend growth, which is sitting at 5.42% yearly. And if we have a closer look at this, we can see that indeed they have been increasing their dividends very steadily over the past 5 years. So overall, Qualcomm is looking very well. Their profits are growing at very high rates, they have very nice consecutive dividend growth, and they are undervalued compared to their earnings and compared to their free cash flow, which is very unusual with tech companies these days. And now let's finally get to calculating Qualcomm's intrinsic value, first using the Graham's formula revised. And here we take the 5-year earnings per share, the base PE, the 5-year earnings growth estimate, the growth rate multiplier, average yield on AAA corporation bonds, and the current yield on AAA corporation bonds. Now, first of all, we have to predict the 5-year earnings growth estimate. And I do this based on the research I do in the back end and based on the 9-pillar analysis. So I predict the high earnings per share growth at 28%, medium earnings per share growth at 23%, and low earnings per share growth at 18% over the next 5 years. I then average this out and average it out with the analyst predictions to get a 5-year earnings growth estimate at 17% yearly over the next 5 years on average. And this gives us an intrinsic value of $286.62, which is 44% higher than the current trading price of the company. Now, for the next valuation model, we take a look at the free cash flow of the company. We can see that on average over the past 5 years, it has been growing at a rate of 33.17% yearly. Now, in the discounted cash flow model, we predict the free cash flow over the next 10 years plus. So I predict a high growth of 18%, medium growth of 13%, and a low growth of 10%, and get a calculated growth rate of 13.7% into the future. Now, to calculate the present value of that future free cash flow, we plug in a discount rate at 11.1%, which is essentially the minimum rate of return I want from my investment. And then summing up all of that present value of the future free cash flow, adding cash and cash equivalents, and subtracting total debt, we get an equity value, which we divide by the shares outstanding and get an intrinsic value of $287.67. Again, quite higher than the current trading price. Now, for the next valuation, I want to compare Qualcomm to 4 of its competitors. And to do this, we take the company's current stock prices and divide by their earnings per share to get their PE ratios. Now, right away, we can see the PE ratio of Broadcom is extremely high compared to its competitors. So we will actually remove Broadcom and we will only compare Qualcomm to Texas Instruments, Applied Materials, and Lam Research. And when averaging out their PE ratios and multiplying by the earnings per share of Qualcomm, we get an intrinsic value of $241.60. And that is because Qualcomm's PE ratio is lower than the PE ratios of its competitors. Now let's move to the final valuation model, the dividend discount model, where we take the dividend payouts over the past 5 years and calculate the average growth rate to be sitting at 6.77%. Now into the future, I project a growth rate of 7.67% and get an intrinsic value of $104.69. And the reason why the intrinsic value from the dividend discount model comes out lower than the current trading price is that the discount rate, or our minimum rate of return, is quite higher than the growth rate we project into the future. And finally, let's jump to our ultimate valuation, where we average out the 4 valuation models and get an intrinsic value of $230.14, which is 43% higher than the current trading price of the company. And with a margin of safety of 30%, we get an acceptable buy price at $161.10. So based on our 9-pillar analysis, we know that Qualcomm is doing very well, and we also know that it is currently undervalued by about 40%. Now, one of the main tools I use to do my research in the backend is Seeking Alpha, which I recently partnered with. It shows you all the news regarding the companies you are researching and raises their positives and concerns. And so if you want to get Seeking Alpha with a discount, make sure to use the link in the description. And with that, I hope that you enjoyed the video. Make sure to leave a like and subscribe, as it really helps me out.